Here's how to calculate the net operating income, or NOI, of a rental property. When appraising buy-to-lets or looking at project options, it's important to know exactly how much rent you collect goes towards running the property. Your net operating income, or NOI, determines the revenue and profitability of investment real estate. The purpose of NOI is to give investors a look into the true cash flow of a property, how profitable it is or isn't, how much it costs to maintain the property, as well as the overall health of the investment. When all operating costs and contingencies are deducted from the gross rent, you are left with the net operating income. The extent of each expense deduction will vary amongst investors based on their personal circumstances and experience, appetite for risk, and the nature of each property. We take the following costs into account when running appraisals to calculate our NOI: agent fees and management costs, repairs and maintenance, a void period allowance, utility and council tax if the property is rented, bills included, TV license and broadband, cleaning and health and safety checks, fire alarm testing, building insurance, any gardening costs, as well as service charges and ground rent if it's in an apartment building. Subtract these operating costs from the gross income and then you are left with the net operating income. You may note that mortgage and finance costs are not included in these deductions. This is because the amount of debt can vary from investor to investor. To calculate the true cash flow of a property, you'll need to subtract these additional expenses from the NOI. The net operating income can then be used to calculate your debt service coverage ratios or net yield, which are both important metrics to property investors.